Hello and welcome to Econoday Unplugged on Tuesday, the 12th of May 2020. Mark Pender is across the pond stateside, and I'm Jeremy Hawkins here in London. As governments struggle to get national economies moving again without adding to the COVID-19 death toll, by and large financial markets are still looking through the current global slump in anticipation of much better things ahead. It remains to be seen how much longer such optimism can continue as the downturn in economic data still steepens and deflation becomes an increasing risk as the collapse in demand compounds the recent slump in oil prices, which, despite an unconvincing bounce on promised additional production cuts by Saudi Arabia, are still about 60% lower on the year. In fact, India has just gone one better as coronavirus knock-on effects there actually prevented the publication of today's April CPI report. On which note, Mark, you've just had an inflation update your side.
Yes.
How soft was it?
You mean a deflation update?
Indeed.
Well, it is, the policymakers is we're not in deflation, it's disinflation. Well, month to month, the last couple of months, it is deflation and minus 0.8% overall for April, reflecting oil and just a slew of things from airlines, anything to do with a vehicle. Apparel is getting knocked around. The core fell 0.4%, which is the all-time record. That's 63 years of data, and it's never fallen this much. And that was just below the Econoday consensus range. But this
was
measure,
that broad-based? Was that like everything going down?
Pardon me?
Sorry, in the core index, was that sort of everything going down?
Yeah, well, it excludes energy, which is the most negative factor in the month. 21% decline in gasoline. Also excludes food, which is rising very sharply, especially food at home, but nothing to the extent that oil is falling. But the core was just about everything outside of medical services and food. Everything else was going down. And the year-on-year rate for the core is at plus 1.4. So it's still safely in the plus category, but it's going down now. That's disinflation. But overall prices are at 0.3% on the year. They don't have a lot of room to go, but they can fall into the negative zone now and then because of energy, especially over the years. But then they pop right back up. Whether they'll pop right back up now is another question. But, there is a silver lining in this is because of all the economic stimulus we're getting, whether it's government spending or central bank loans. These are all very inflationary and risk, debasing currency. But that doesn't seem to be a risk right now for policymakers at all. So, continued, extended, however much stimulus you can throw at this is, that hasn't been diminished at all.
It's interesting to say about that. It just shows us only the changing the circumstances, isn't it? And I suppose I just reference the Norges Bank, so the Norwegian central bank last week. They came out with their updated, I think it's quarterly inflation report. They have a 2% inflation target, like so many central banks these days. And they showed their target being exceeded in 2020, 2021 and 2022. So right through the forecast period. And yet they came out and cut interest rates by 25 basis points down to zero. So it really does, I think, highlight the fact now that central banks and, let's say, positive inflation rates is simply not an issue for them anymore.
They didn't update their inflation targets?
No, they kept the targets. They forecast inflation. They maintain inflation target a bit like UK and the ECB have at the moment. UK's 2%, ECB just short of 2%, whatever that really means.
Yeah.
But no, that has left the same. But they showed inflation above it over the long period, which means that that policy, strictly speaking, is too loose. Well, and yet they still came out and cut rates.
Well, me personally, I've already deleted all the 2% lines in my inflation graphs.
I know what you mean. Start marking the minus 2% on this rate.
Well, a little grim humor. That's all. What can you say?
Well, it's interesting I was looking at some of the other figures we've had out. I mean, inflation also all around the world is clearly coming down now. And obviously, as you mentioned, a big chunk of it has got to do with the collapse in oil prices. But we are also, seeing it seems, certainly across Europe, and it seems Asia, increasing signs now that, the downturn in demand led by the COVID crisis is simply having ultimately a deflationary impact on the level of prices. Mm-hmm. And even countries such as, I don't know, the likes of China, well, okay, we still have, a 3.3% headline inflation rate there. That, when it came out, was well short of market expectations, the lowest we've seen in quite a while. And their non-food index in China is running at just 0.4% now. So, I mean, wherever you want to look, these inflation numbers are low, and quite clearly, unless something happens to oil, and that's kind of hard to see at the moment, there's got to be a chance they go sub-zero. And in fact, just on that note, interesting enough, Ben Broadbent, he's one of the deputy governors for the Bank of England. He was on the wires literally about 20 minutes or so ago, warning that UK inflation could go negative at the back end of this year and early in 2021. Now, he's pretty quick to rule out, this doesn't mean deflation. That's the last thing, obviously, a central bank wants to admit to. But again, it's just a sign of the times that we'll end up at this rate with real interest rates going up because inflation is going into negative territory.
Well, I just called up the Chinese PPI here on my calendar, my widgets calendar events here at Econoday, and 3.1% negative year on year for Chinese PPI wholesale prices. So underneath the consumer prices, that's deflationary, and the month to month was minus 1.3. So that's pretty significant under the zero line. But I also saw. Was it last week? Was it Swiss consumer prices, or was it Swiss producer prices, or both, or import prices? They were under the zero line. They've been there for a couple of months. Is that right?
Yeah, Switzerland, I must say, it'd be interesting to see what happens at the next Swiss National Bank meeting. Their central bank, and that's due on June the 18th, because they're starting to see some really bad numbers coming out now. I think you mentioned the actual inflation figures, the CPI figures for April. They show a year-on-year rate now of minus 1.1%. And it was minus 0.5% in March, but say a big fall coming down in April itself. And if we strip out the usual food and energy components, look at the core, well, that's now running at minus 0.5%. Now, of course, for them, part of the problem, as we talked about so often in the past, is the fact the currency is so ridiculously strong. And so while it would seem, looking at the equity markets, that there's this kind of underlying belief that things are going to work out okay and therefore it's fine to keep buying equities, from the currency market side, particularly in Europe anyway, people are still buying Swiss francs, even though interest rates drop pretty well right across the curve, don't give you any money. They're all negative.
Yeah. Well, it's interesting for the listeners on European inflation data. They're out very early. That May will be out in a couple of weeks. Is that right? And that's a couple of weeks in advance of anything out of the U.S.
Yeah, that's right. And well, we've already got the April flash HICP, as they call it, in the Eurozone rate. I mean, that came in at just 0.4% on a headline basis. That's year-on-year inflation of the Eurozone, provisional April, down from 0.7% final in March. Now, that's going to come down almost certainly again once we get into May. And the risk for them, of course, is always, like so many central banks, they concentrate more upon the core rates. But the core rates are starting to move down as well. So there are going to be some genuine concerns there.
Well, it seems that the European data has generally been especially employment, much more stable than what we're seeing in the U.S. or Canada, especially where we're getting this massive job losses. But is the inflation going to be? Does that also? Are everything just more stable in Europe compared to the U.S.?
I've got to be honest and say, no, I don't think that is the case. I think it's got much more to do with the fact that most of the real side, the real economic data, are lagging, several weeks behind what you see. So when you look at what's happening to, the soft data, the survey data, let's go back to the other week, it's record falls and everything, it's unprecedented declines in everything. So I do believe that once we start to get the April data coming through, when you get the real lockdown effect starting to take place, then you really are going to see some pretty nasty numbers. As it is, those kind of hot spots we've had in Europe, which had the lockdown being entered into first, so in particular the likes of Italy, which was for a long time the major problem area for for the coronavirus. Retail sales there for March, they were down 20.5% on the month. Now that we're going to start to see figures, I think, like that for the rest of the Eurozone once we really get into the April numbers. Indeed, Eurozone March retail sales themselves were down, just over 11%, if I remember rightly. Mm-hmm. So we are starting to see some really nasty figures coming through now.
Right, and that's the production side. Now, Italy, I'm just checking the calendar. They came out with industrial production today, right? And the production side is is it declining less severely than the demand side, or is it the same?
Well, I mean, for what it's worth, I mean, the month-on-month change was even worse than the retail sales. I say retail sales were down almost 21%. Industrial production was down over 28%. So, I mean, it's just, it's the same issue, isn't it? The workers can't go to work and actually produce anything. The workers are at home, so they got limited spending opportunities, etc., and of course, lost income. Yeah. So it's difficult to dig their way out of this.
Well, I was thinking about that. Production, the structure of production is going to have to change. There's going to have to be more distancing in the facilities, and that will take time, investment, and there'll be delay. But it's not like you can't do it. You just can't work elbow to elbow anymore. Like that was, I guess, a typical production. It's efficient, gets everyone close together on the conveyor belt, so to speak. But
yeah, it's going to be interesting. I mean, last week, I suppose I should mention just quickly, we had the Bank of England meeting. Now, they came out as expected with no change in interest rate. So bank rate left at 0.1%. There was a split on their quantitative easing target. A couple of members, Saunders and Haskell, who really, they're the two main doves anyway. They came out asking for an extra 100 billion of asset purchases. But part and parcel of last week's report was we got the updated quarterly, we used to be called a quarterly inflation report from the bank. Now they refer to it as the monetary policy report. And that gave their first kind of indication of what they kind of think might happen. Now, they don't actually call it a forecast anymore. I can't say I blame them for that because no one's got a clue. They refer to it as an indicative scenario. And this suggested UK GDP would go down on a quarterly basis about 3% in the first quarter, which, to be honest, is nothing particularly surprising. Second quarter, they're talking about a collapse of 25%. But then they expect a V-shaped recovery and output to get back to its sort of pre-recession level by the middle of next year. And I must say, I'm a bit dubious on that. I think, from what you were saying about when the world starts working again, it's going to be working in a very different form to how it used to before. So somehow you've got to get these people to get back to, current, pre-recession levels of output in the UK or any other country. You're going to need, as a starting point, ideally, the same workers working the same hours in the same environment as productively as before. But they're not only working in the same environment, they probably won't be working the same hours. There probably won't be as many people working anyway because some won't be re-employed. So I think this idea of a real quick V-shaped recovery, it may be to some extent, but getting back to where we were, wouldn't surprise you, it takes a lot longer.
You have to change the physical structures of the production facilities, both, the structures and the equipment, and perhaps even retraining. You were talking about the doves and the BOE. There is risk to extra stimulus, and that this stimulus ends up in further, perhaps I want to give myself my hand away, but it creates further inflation in the equity prices, which creates then again the risk of a counter move and a collapse. So you can't, there's a balance here of how much stimulus, can they really successfully and favorably impact the situation with.
And I think, kind of the bottom line to that little lot is that really monetary policy is not the appropriate policy to be changing to deal with an international virus, which has got nothing to do with economics. At the end of the day, the only real way out of this is to get a vaccine. We keep getting talks about, someone's got, developing one. We may or may not get one this year, or it's going to be next year, or who knows, we get one in the next few months. But until that actually happens, you can throw as much money as you want at these financial markets. That's not going to make people go back to work, even if they're supposed to, if they don't feel safe.
Well, AIDS was a virus, and it took a generation to solve. So
difficult. Okay, what else have we got? I suppose from the European side, I just mentioned it briefly last week, and I suppose give a quick update because this could be important. For listeners who hadn't tuned off by then, I mentioned last week that the German High Court, the Constitutional Court, has basically gone to the ECB and told it that it's not really happy with the amount of bonds that it's purchasing, and wants what they call a proportionality report from the ECB delivered within 3 months to basically explain what's going on. Now, the ECB, as you can imagine, is none too chuffed about this. At least 4 members of their council came out last week and said, look, it's got nothing to do with Germany's constitutional report. We are independent. We're going to do our own thing. We've also now had the EU commissioner, the EU president, push comes to shove, we could actually see the European Commission executive arm considering possible infringement proceedings against Germany. So this is starting to build up, and I think at the moment there's clearly a lot of politicking going on, because the last thing either side wants to see is the European Union fall apart. But were this to continue as it is at the moment, at the same time as when you've got all this fracturing taking place due to the COVID virus effects on countries in the south, particularly like Italy, which is simply desperate to get funding out of the EU Commission, and these talks we talked about in the past, this rescue fund, are just dragging on and on and on, not really getting anywhere. Then all these sort of fault lines we're seeing across the Union, or certainly the Eurozone, if this thing runs on much longer, it really could be significantly damaging to the outlook for, well, certainly for the European currency anyway.
Immediately, does this German court ruling have any immediate impact structurally on European bailout?
Not immediately, no. I mean, ostensibly, the German High Court has given the ECB 3 months. So there's going to be a lot of talk between now and then as to what's going on. I think, as we've talked about in the past, the German attitude towards fiscal and monetary policy is very much down the hard line route. They still take the view that, as you were saying earlier, it's possible if they throw so much money at the economy from all these central banks doing the same sort of thing, could ultimately lead to, if it's not an increase in the likes of CPI inflation, it leads to asset price inflation, which is completely and utterly unjustified and leads to a collapse somewhere. And that is still very much the kind of fear that I think a lot of German policymakers adhere to at the moment. But they want to maintain the economic and monetary union across Europe. They don't want to see it fracture. So it's going to be really interesting to see how the politics both across the region and even within Germany itself develop over the course of the next few months.
And how is the German economy doing right now? Is it fracturing?
Well, it's struggling like everybody else, and we'll actually get at long last, because these figures are so late, we'll get the flash German first quarter GDP data out on Friday. Now, our guess, I don't think we have a full consensus on that yet, but it looks like, off the top of my head, will be somewhere down between probably 2 and 3% on a quarter for German flash GDP. But again, if you look at the more up-to-date survey readings, really they're much in the line with what we're seeing coming out of France, or some of the more industrialized countries within the Union. So they're struggling like everybody else. And for Germany, as we talked about in the past, they are heavily dependent upon exports. So anything which starts hitting global trade again, which we've already got because of the coronavirus, if we do get spat between US and China, over the COVID blame game, if that starts depressing world trade even further, then Germany could actually come out of this extremely badly. So it's hard to see anyone who's doing sort of well in this kind of environment at the moment. Okay, what else we got? I suppose I should mention in terms of central banks this week, or this evening, I should say, we'll get the Reserve Bank of New Zealand. Now, no real change in interest rates is expected there today. They already cut interest rates to a record low of 0.25% not long ago. But there is quite a lot of speculation they could come out and increase their asset purchases, possibly even double them. And as we said, I think last week, it's just worthwhile keeping an eye on the RBNZ at the moment, because it was their central bank governor who hinted that the bank could use its asset purchases to directly finance the government debt. Now, that's been turned down apparently by the Kiwi Finance Ministry so far, but just by virtue of the fact it's already out there. We could see the Reserve Bank pushing for more and more of this if the economy continues to spiral down.
Well, an interesting thing I think to watch for New Zealand economic data is they seem to be kind of a control group. Their economy and their public seems to be much more, the virus impact is much more limited. So it'd be interesting to see. In theory, you would think that they would do better economically than others, at least internally. But it's something to keep an eye on to see if the global demand or dislocations, how badly it affects them.
Yeah, it's true. I mean, it's interesting. I think at the moment you have these discussions ongoing about creating a sort of trade bubble involving Australia and New Zealand. So effectively, you get free movement of trade and everything else between Australia and New Zealand, but you would still have barriers put up, particularly in terms of people moving into the country. You still have quarantine restrictions and everything else for those countries, for the rest of the world. So of course, again, that's again just another the hit to global trade, or at least it's not relaxing one of the big constraints we got on global traders generally, particularly if other countries like Europe or whoever it starts going down the same road. Well, difficult times. I think I've done my bit. Anything else you fancy sticking in?
Well, I guess I just it's not a note of optimism, but we had the employment report, U.S. employment report, and it was along with the Canadian April reports, and they were cataclysmic and catastrophic. 20.5 million decline in non-farm payrolls, which was as expected.
Still go up. Equities still go up,
and and they rallied on it. Yeah,
well, that's what I'm saying. Less than expected, but the numbers are just so ridiculous.
There's so much hot money in the market because of all this stimulus. Investors borrowing that money and putting it into the stock market, and if you get a ride on the Nasdaq, you can turn a quick buck. And also the unemployment rate. There's both Canada and U.S. are hair splitting, fudging a little bit on how you define a temporary job loss. It's just about 15% for the U.S. and Canada's roughly the same, or 20% unemployment, depending on how you define these losses. But since that U.S. report, there's been 7 million new initial claims, because that was sampled in the middle of April. Since then, there has been 7 million initial new claims, and the Canada consensus for Thursday's weekly jobless claims report in the U.S. is another 2.5 million. So it's going to be another ugly, very, very ugly month for the May report. And this is, however deep we talked about it, when you get in there, it feels you're cold and lonely.
Yeah. Well, on that cheery note, then, let's call it a day for today. On behalf of Mark and myself, thanks as always for listening. We'll be back next week, so do join us then. And in the interim, remember to keep up to date with all the key data and events in Econoday's global economic calendar. Stay safe, and we'll see you next time. Bye for now.